Before you crunch any numbers, stop and think. What is your startup trying to achieve in the next 12 months? Is it to break even, hit revenue target, or secure funding? Setting clear financial goals gives your budget direction. You can't allocate resources wisely if you don't know your end game. So define key objectives such as revenue targets, customer acquisition goals, and operational milestones. Then tie each rupee in your budget back to these outcomes. Define your business goals and budgeting objectives. Before you crunch any numbers, the first and most critical step in budgeting is to define your business goals and budgeting objectives. Think of your budget like a GPS. You can't use a GPS without inputting a destination. The same goes for your startup. You need to know where you are going to plan how you will spend. Ask yourself, what do I want to achieve in the next 6 to 12 months? Do I want to break even, acquire customers, launch a product, or secure funding? These goals will drive your financial decisions. For example, if your goal is rapid growth, expect to allocate more to marketing and hiring. If it is early profitability, you will focus more on cost control. Once your goals are clear, turn them into budgeting objectives. How much should you spend in each area? Where should your capital go first? What KPIs will measure success? Break them into short-term, say 0-6 months, and long-term 6 to 12 months buckets. Keep them documented and visible. Review and adjust monthly. Your budget must evolve with your business. Key takeaways are: goals shape your budget. Budgeting without direction wastes money. Prioritize, document, and review regularly. Estimate your startup costs. Let us talk about estimating your startup costs, the money you need before your first sale. Next, estimate what it will cost to start your business. This includes one-time expenses like licenses, equipment, website development, and legal fees. Don't forget the hidden costs, insurance, branding, and initial marketing. Create a startup cost checklist. Be realistic, but don't under-budget. If you miss the mark, you'll be out of cash before you even launch. Use benchmarks from similar businesses if you're not sure what's standard. There are two types: one-time costs, licenses, equipment, website, legal setup; recurring costs, rent, payroll, software subscriptions, marketing. Use a spreadsheet to list every item. Estimate each cost based on real quotes or market research. Flag which ones are one-time and which repeat monthly. Don't forget hidden costs: insurance, branding, domain hosting, professional services. And always add a 10 to 15% contingency buffer for surprise expenses. The result? A clear number showing how much capital you need to start, and a roadmap for investor discussions or loan applications. The key takeaways are: know what it takes to start up. Research thoroughly. Identify fixed and variable expenses. Once you are up and running, you'll face two types of costs: fixed and variable. Fixed expenses like rent, salaries, and software subscriptions stay the same every month. Variable expenses like marketing, shipping, or raw materials depend on your sales volume. Track both separately. Why? Because during a cash crunch, you can cut variable costs first. But if fixed expenses are too high, you may be burning money every month without knowing it. Next, distinguish your fixed and variable costs. Fixed expenses stay the same month to month: rent, salaries, subscriptions, insurance. Variable expenses change with activity: inventory, shipping, advertising, contractor pay. This distinction matters. During a downturn, you can trim variable costs, but high fixed costs lock you in and increase risk. Track both separately in your budget, and measure fixed expenses as a percentage of your expected monthly revenue. The lower, the safer. Key takeaways are: fixed can seem predictable, but risky if too high. Variable, flexible, can be controlled. Budget both clearly. Forecast revenue. This is the tricky part, revenue forecasting. Yes, you are guessing, especially in the early days, but it is a necessary guess. Start by estimating your average price point and expected sales volume. Use conservative numbers. Then project your monthly revenue for at least 12 months. Build 3 scenarios: best case, moderate case, and worst case. This helps you stay grounded and prepares you to pivot if sales don't go as planned. Yes, you have to forecast revenue, even if you are pre-revenue. Start with average price per unit, service, estimated volume sold per month. Example, Rs 25 per unit, X 200 units, Rs 5,000 month. Now build 3 scenarios: best case, base case, worst case. Ramp up slowly. Don't assume instant sales. Be conservative, especially early on. Account for seasonality, industry cycles, and customer ramp-up time. Key takeaways are: forecast based on price x volume. Build realistic and multiple case scenarios. Expect gradual growth, not instant traction. Understand your cash flow. Cash flow is not the same as profit. You can be profitable on paper and still go bankrupt if you run out of cash. So track every inflow and outflow by week or month. When do you pay bills? When do you get paid? Use a cash flow statement to spot timing issues. Maybe your clients pay in 60 days, but your vendors want payment in 30. Fix those gaps early. Cash flow is the lifeblood of your startup. Revenue is important, but cash flow is survival. Track how money moves in: sales, funding, loans, out, rent, payroll, marketing, bills. Problem: you may make a sale today but get paid in 60 days. Meanwhile, bills are due in 30. That's a cash crunch. Use a monthly cash flow forecast, update it monthly, highlight upcoming shortfalls early so you can plan solutions. Keep a minimum 3-month runway at all times. That means having cash to cover 3 months of fixed expenses. Key takeaways: cash flow profit, track inflow versus outflow monthly. Maintain a 3-month safety cushion. Plan for contingencies and emergency funds. Unexpected costs happen. A client pulls out. A piece of equipment breaks. A regulation changes. If you don't have a buffer, one surprise can shut you down. So build in a contingency line, 5% to 10% of your total budget as a safety net. Also, keep a separate emergency fund, ideally 3 to 6 months worth of fixed expenses. It is not just smart, it is survival. What if something goes wrong? A big client backs out, a laptop breaks, regulations change. You need 2 protections: contingency line in your budget, 5 to 10% of total spent; emergency fund, 3 to 6 months of fixed expenses. Also, identify non-financial risks. What if your supplier fails? What if your key developer quits? Backup plans save time and money during chaos. Key takeaways: always expect surprises. Build a financial buffer and risk plan. Investors respect proactive planning. Use budgeting tools and software. You don't have to build your budget on a napkin or Excel sheet anymore. Use tools like QuickBooks, FreshBooks, or LivePlan. They help you visualize, adjust, and share your budget easily. Plus, many sync with your bank to automate real-time tracking. Don't just create a budget, use it monthly. Compare actual versus forecast. Adjust quickly if you are off track. Your budget should live and breathe, not sit in a drawer. Don't do it all by hand. Use tools that simplify your workflow. Top options: QuickBooks for accounting and forecasting, LivePlan for business plans and investor decks, FreshBooks for easy invoicing and budgets, Google Sheets, flexible and free for early stage. Pick tools based on your budget and complexity. Integrate them with your bank. Review your budget monthly. Don't wait until the quarter ends. Key takeaways: Use tools to automate and visualize. Pick scalable software. Make monthly reviews a habit. Final thoughts. Budgeting may sound tedious, but for startups, it is your roadmap and your lifeline. Every rupee you spend should have a purpose. A good budget does not guarantee success, but no budget guarantees problems. So start today. Define your goals, get your numbers in order, forecast realistically, and review often. Financial budgeting is not just an exercise in math. It is the framework that supports every decision you make as a founder. Done right, it gives you confidence, direction, and control. So take the time, use these steps, review regularly, and budget like your business depends on it, because it does. If you do, you will not only survive, you will thrive. Thank you. Thank you for watching my video. Find it informative and useful? Like and give a thumbs up. Share this video with your colleagues and friends. Subscribe to my channel and support me. You will get notifications whenever I upload a new video. Kindly express your comments in the comments section. Your comments are of more valuable to me. Within a month, I have uploaded 7 videos, and I have received very good response, and it is really encouraging. Thank you, my dear viewers. Before concluding, here is an important message for all my viewers. My next video is titled as Mastering the Negotiation Skills for Success. My next video is vital and very important for every small or medium business owner, whether it is a financial decision-making or customer engagement. Without mastering the negotiation skills, you cannot push your business to success. Don't forget to watch my next video, Mastering the Negotiation Skills for Success. All the best. Whoever have not subscribed yet, kindly subscribe now. See you soon. Thank you once again.